Hey, we can't hear you, sir.
Hear me. Can you hear me now? Can you hear me now, guys? Sorry, I don't know what's going on with this laptop. Okay, great. So you guys can all hear me now. Perfect. Okay. Thank you everyone for assisting me with that. Okay, now that I know you can see the lecture slides and can hear me, let's carry on with our lecture. So previously, when you have encountered borrowing costs, you would expense these costs. Okay, so what are borrowing costs? Who can give me an example of what borrowing costs are? So what are borrowing costs? Okay, I see a few people getting it correct in the chat. So borrowing costs are those costs associated with borrowings. So a borrowing is like a loan. So think about your interest expense, your finance charges. Those are borrowing costs. Okay, so let's go to our learning objectives and just make sure we understand what we are going to be covering in borrowing costs. So first we need to identify whether there are borrowing costs, okay? There can only be borrowing costs if there are borrowings, okay? Then once we have determined or identified whether there are borrowing costs, then we need to decide whether to capitalize borrowing costs or not. So previously, when you encountered borrowing costs, do you agree that these borrowing costs get expensed usually? So usually we will have interest expense, and this interest expense will be paid, and this interest expense is an expense, okay? Do you guys all agree that usually interest expense is an expense? That's what the classification of interest on borrowings is. However, in certain situations, when we have something called a qualifying asset, which is what we'll go through just now, borrowing costs can actually be capitalized. Okay, so when certain criteria are met, borrowing costs may be capitalized, but not all the time. Okay, we'll go through the criteria later on and see when borrowing costs can be capitalized. So once we have identified whether there are borrowing costs and we have decided whether we can capitalize the borrowing costs or not, we need to actually calculate what the borrowing costs are and determine what portion is capitalized and what portion is expensed. Then once we have determined what borrowing costs can be capitalized and what borrowing costs can be expensed, then we can disclose these borrowing costs in the financial statements of a reporting entity. Okay, so those are our learning objectives for today. Let's go over to the next slide. So where's your information for this section going to come from? Okay, so I had an email yesterday from a student who was looking for the chapter in the prescribed textbook, and there isn't actually a chapter in the prescribed textbook on borrowing costs. So you can use the slides and the practicals and tutorial questions, and then when you are at the library next, you can take out a textbook called Gripping GAAP, which is the recommended textbook to this course. So it's not prescribed, it is recommended. Okay, so in Gripping GAAP, there is a chapter on borrowing costs if you want to have a look at this chapter and do some additional reading. Okay, but for the most part, most of your information will come from your practicals and tutorial questions and your slides. Okay. Also, if you do have a set of the IFRS standards, then you can find borrowing costs in your standards. It is IAS 23, okay? So if you find another student who has the standards, or you find another student who has the Grip and Garp textbook, you can have a look at IAS 23, because this will set out the borrowing costs, okay? So if we have a look at the next slide, we need to understand some definitions in this section, okay? So we need to understand what are borrowing costs, and I already asked you this, and a lot of you said it was finance charges, it was interest on a loan, which were all correct, okay? So borrowing costs refer to interest and other costs that an entity incurs in connection with the borrowing of funds, okay? So do you agree you cannot have borrowing costs if you do not have borrowing of funds? So in order for there to be borrowing costs like interest expense, you need to have a borrowing of funds like a loan, okay? So that is the definition of borrowing costs. So once you understand what borrowing costs are, we then need to go look at the definition of a qualifying asset, okay? So you all should remember, what is the definition of an asset? So if we ignore the term qualifying asset at this stage, what is the definition of an asset that you would have learned in your first lecture? Can anyone assist me? What is the definition according to the conceptual framework? What is the definition of an asset? Does anyone know what the definition of an asset is? You don't know what the definition of an asset is. I see someone has raised their hand. If someone wants to unmute their mics and tell me what the definition is, they can. Okay, I see someone has put in the chat. Is there someone who wants to speak? Okay, it sounds like you guys are all a bit shy today, but let's have a look at the definitions of an asset in the chat. So, the sorry, the definition of an asset, someone is saying it is a resource. MB is saying it's a resource that is owned and controlled by an entity due to past events and future economic benefits are expected. Okay, and then that is correct. And then NC said it is a resource owned and controlled by an entity due to past events from which future economic benefits are expected. Okay, 100% correct. So you should recall that the definition of an asset is a resource. It must be controlled by the entity, and it is as a result of past events from which an inflow of future economic benefits is expected. Okay, so that is the definition of an asset. But what is a qualifying asset? Okay, so a qualifying asset is an asset that is going to take a substantial period of time to get ready for its intended use or sale. So think about a building, a factory, or a manufacturing plant. If a manufacturing plant is being built and it is going to take a substantial period of time to get ready before it can be used, this is going to be a qualifying asset. Okay, so not all assets are going to be qualifying assets. If we buy a factory and it's already ready, then there's not going to be that substantial period of time that is needed to get it ready for its intended use. So if we buy a factory and there's nothing left that needs to be done, it is already able to be used immediately, that will be an asset. and it will be recorded under PPE in our financial statements. However, it won't be a qualifying asset, okay? So a qualifying asset is an asset that is going to take a substantial period of time to get ready before it can be used. So like I said, an example of this is if we decide to build a factory instead of buying a factory. If we build the factory, it can take years before it is ready, okay? It could take 12 months, it could take 10 months. It is going to take a substantial period of time before it is ready, before we can use it and start manufacturing all of our items, okay? So just remember, when you're looking at an asset, specifically with borrowing costs, we can only capitalize borrowing costs if it meets the definition of a qualifying asset. Okay, so I see someone is saying if we have an asset which is ready to be used, we don't capitalize the borrowing costs. That is correct, okay? You can only capitalize the borrowing costs if you have a qualifying asset. And a qualifying asset is going to be an asset that is going to take a substantial period of time to get ready before it can be used or sold, okay? Do you guys all understand that? So we've looked at the definition of borrowing costs, and we said it is interest that an entity will incur when it takes out a loan, okay? So we covered that. And then we need to consider what is an asset, and there we looked at the definition of an asset that you are all familiar with in terms of the framework. But further to that, in order to capitalize borrowing costs, we need to make sure we have a qualifying asset. And a qualifying asset is an asset that is going to take a long period of time before it can be used in the way it is intended to be used. Okay. So let's just go on to the next slide. Now that we have had a look at the definition of what are borrowing costs, what is a qualifying asset? Okay, so we're going to look at some examples just now where we will answer those questions. So if we have a look over here at borrowing costs, so when you covered borrowing costs last year, and you may not have covered it in detail, but you should know that last year when you had a borrowing cost like interest expense and you had your finance costs, these were all expensed, okay? You would expense them in your financial statements, and that represented how you would treat borrowing costs under IFRS for SMEs. So last year, when you looked at it from the perspective of IFRS for SMEs, it was correct to expense all the borrowing costs, okay? So you expense the borrowing costs and you were happy with that, okay? And that was correct because you were looking at it from the perspective of IFRS for SMEs. However, this year, we are going to look at full IFRS. And when we look at full IFRS, if we have borrowing costs and they are incurred on qualifying assets, we can actually capitalize these borrowing costs, okay? So the standard, if you want to do some further reading, is IAS 23, okay? So we're going to have a borrowing costs and we're going to consider, is it incurred because we are making a qualifying asset, okay? If the borrowing costs are incurred because the loan has been taken to build the factory, that interest expense on the loan can be capitalized to the qualifying asset we are building, okay? So just remember, last year, all borrowing costs are expensed. That was IFRS for SMEs. This year, we are looking at it from the perspective of full IFRS. So when we look at it from the perspective of full IFRS, if the borrowing costs relate to a qualifying asset, we can capitalize the interest expense, okay? Under full IFRS again, if the borrowing costs relates to just a normal asset, which is not a qualifying asset, the interest expense will have to be expensed, okay? We can only capitalize the borrowing costs if it is on a qualifying asset, okay? So let's have a look at the next slide. So here we've actually covered this slide already. So I asked you, what was the definition of an asset? And you said to me, an asset is a resource that is controlled by the entity as a result of a past event, which will result in an inflow of economic benefits. Okay, you guys knew the definition of the asset. And then remember, when we want to recognize an asset, it's not just enough to meet the definition of the asset. The recognition criteria also needs to be met, okay? So if you recall from your week 1, when you would have covered the conceptual framework, the recognition criteria means that there must be future economic benefits that are probable, okay? So if we have probability of future economic benefits and the cost can be reliably measured, then yes, we can recognize an asset, okay? So first of all, you will consider, do we have an asset, okay? If the item we are considering meets the definition of an asset and meets the recognition criteria, then you will ask yourself, is it a qualifying asset though? Is it going to take a substantial period of time before it can be used? Okay, and that will determine whether it is a qualifying asset and whether we can capitalize the borrowing costs that are related to that qualifying asset. If we go through the definition of an asset, for example, if we buy a factory and we go through the definition of an asset and we see, yes, it is an asset and yes, it meets the recognition criteria. However, if it is already ready to be used, that means it's not going to take a substantial period of time before it can be used. Then even though it's an asset, it's not a qualifying asset, and any borrowing costs may not be capitalized then because you do not have a qualifying asset, okay? So it's important to first ask yourself, do we have an asset? Then you will go through the definition of an asset and you will go through the recognition criteria. Then once you've determined if you have an asset, then you will look at the definition of the qualifying asset. We have a qualifying asset. Is it going to take a substantial period of time before it is ready? If yes, if it is a qualifying asset, then we may capitalize the borrowing costs. If it is not a qualifying asset, then any borrowing costs will have to be expensed. Okay. Are you guys still with me? I think when we look at some examples, it is going to make more sense, okay? So if we go to the next slide, there are certain criteria that need to be present in order for us to be able to capitalize the borrowing costs, okay? So borrowing costs may be capitalized to an asset if they meet the basic recognition criteria of an asset, which is what we went through. And then it also needs to meet these criteria here. It sounds like someone doesn't have their mic muted. Are you guys able to mute your mics? Yeah. So we want to determine when can we capitalize the borrowing costs, and we can capitalize the borrowing costs to an asset if they meet the basic recognition criteria of an asset, which is what we went through on the other slide. But then these criteria also need to be met, okay? the borrowing costs must be directly attributable to the acquisition, construction, or production of a qualifying asset. Okay. So if we have borrowing costs, we need to ensure that the borrowing costs or the loan is not going to be used just for any old purpose. We need to determine that the borrowing costs relating to the borrowings are going to be used and directly attributable to the acquisition, construction, or production of a qualifying asset. Okay, so we need to make sure that whatever loan we're getting, if we want to capitalize the borrowing costs, that loan must be used in applying or constructing or producing a qualifying asset. Okay, it's not just enough to have a loan that we use to pay salaries and we use to have a party at the end of the year. We need to make sure that that borrowing or loan is going to result in a qualifying asset being produced, acquired, or constructed. Okay, so there's that word directly attributable that you may have come across when we did PPE. So directly attributable means that the cost could have been avoided had the asset not been acquired, constructed, or produced. So if we decided to not produce a factory, then the loan would not have been incurred. Okay, so that loan must have been incurred because we're going to use that amount to make a factory. Okay, we're not going to take a loan and use it to pay salaries and go on a holiday. That loan must only be used or directly attributable to acquiring, constructing, or producing that qualifying asset. Okay. So now that we have determined when borrowing costs may be capitalized, and just to refresh, it may be capitalized if an asset definition is met and the recognition criteria is met, and then those 3 bullet points need to be met. That borrowing must be directly attributable or used for acquiring, constructing, or producing a qualifying asset. Okay, and we said that directly attributable means if we decided not to acquire, not to construct, or not to produce that asset, we would not have incurred that borrowing. Okay, so that is what directly attributable means. So if we have a look at the next slide, we need to determine when do we start capitalizing the borrowing costs. Okay, there are certain criteria that need to be met before we can begin the capitalizing of the borrowing costs. Okay, and if you look at the slide there, it says all the following criteria are met. So it's not one or the other or the other. All 3 of these criteria need to be met before we can capitalize the borrowing costs. Okay, so if activities are underway to prepare the asset for its intended use or sale, and expenditure is being incurred by the entity in preparing the assets, and borrowing costs are being incurred, if all 3 of these criteria are met, then we can commence to capitalize the borrowing costs. Okay, so just to recap, the activities are underway to prepare the asset for its intended use. So an example of this would be construction has started. If we have decided to construct an asset, then construction has started. Okay, then we need to consider if expenditure is being incurred by the entity in preparing that asset. So we'll ask ourselves, is expenditure being incurred by the company to build that factory? And if borrowing costs are being incurred and all 3 of these criteria are met, then we can commence the capitalization of our borrowing costs. So someone has asked, if we obtain a loan to buy a factory which is ready for use, is that factory a qualifying asset? Okay, so let's go back to the definition of what a qualifying asset is. Okay, It's a good question. So a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. So if the asset is already ready and it's not going to take a long period of time to get ready, then it is not a qualifying asset. It will still be regarded as an asset, and that factory will be recorded in our property, plant, and equipment notes. However, that asset will not be classified as a qualifying asset, which means that if there are any borrowing costs incurred on that asset, they will be expensed and they will not be capitalized. Okay, so excellent question. The key word here is that it must take a substantial period of time to get ready for its intended use. Okay, substantial period of time. If it is just an asset that is ready to be used immediately, then it will be an asset, but it will not be a qualifying asset. Okay. Okay, we'll look at that substantial period of time when we look at the examples. Okay. So if we have a look here, we were on slide 8, okay? So we asked ourselves, we've determined that we have an asset, we are going to build a factory. So we've gone through the definition of an asset, and we've said, yes, it meets the definition of an asset, and it meets the recognition criteria. The next thing we need to ask ourselves is, when can we start capitalizing the borrowing costs? And we said that there must be activities underway to prepare the asset for its intended use. So this would be, we have started constructing the factory. Then we need to determine if there is being expenditure incurred by the entity in preparing the asset. So we will pay our builders, we will pay our bricklayers, we will pay all of those people to build our assets, and we are incurring expenditure. Then the last requirement is that borrowing costs are being incurred. Okay, so once all three of these criteria are met, then we can commence capitalizing our borrowing costs to our assets. Okay. Then just a note here, when we refer to the activities, it says the activities do not have to be just physical activities of construction. They could also be related technical and administrative work prior to the physical construction. Okay. Perhaps we are clearing the land and we are like laying a foundation, so we haven't started building the bricks up yet. So if it is administrative and technical work prior to the physical construction, that is still an activity. Okay. Perhaps we took a loan and we had to pay people to remove the forest where we're going to build our factory. That is still an activity. Okay. It doesn't need to be a physical activity. It can also be related technical and administrative work. Okay. So let's carry on to the next slide, where we want to look at capitalization of borrowing costs. When is it suspended? Okay, so capitalization of borrowing costs is suspended if active development of a qualifying asset is interrupted or delayed for a long period of time. Okay, so capitalization of borrowing costs is going to be suspended if the qualifying asset development is delayed for a long period of time. Okay, so there don't seem to be any specific guidelines on what is a long period of time. We can suspend an activity if it is 2 months. I would say you could look at a period of months, okay, but there doesn't seem to be any specific guidance in the standard as to a set time frame. Okay, so you guys are going to have to use professional judgment. Okay, so if we have a look at when we need to suspend capitalization of borrowing costs, if it is going to be delayed for a long period of time. However, if we have a delay and it is only a temporary delay and it is a necessary part of getting the asset ready for its intended use, then we may not suspend the capitalization of borrowing costs. Okay, perhaps we need to let the cement dry, or we need to do something that is compulsory for us to get the asset ready for its intended use, then we may not suspend the capitalization of borrowing costs. Okay. Then if we have a look at a delay that is due to substantial technical or administrative work. So if we have a lot of administrative work or technical work that is relating to the construction of the asset, if it is necessary in getting the asset ready for its intended use, we may not suspend the capitalization of borrowing costs. Okay, so let me give you an example here and ask you, if we were building a factory and we were satisfied we had met the definition of an asset, and then we said this factory is going to take us 12 months to get ready. So it meets the definition of a qualifying asset because it is going to take a substantial period of time to get ready. We have taken a loan of R1,000,000 to build this factory. Okay, it is a loan that we are only going to use for the factory. 6 months into our construction, we have striking, and our workers don't want to work anymore. They are not happy with the pay, and they are striking for 2 months because they have down tools. They refuse to work for the pay that we are paying them. Would we suspend the capitalization of borrowing costs in that case when we have striking? Okay, so we need to ask ourselves, when we look at the capitalization of borrowing costs, okay, it may not be suspended if it is a temporary delay that is a necessary part of getting the asset ready for its intended use. Is the strike necessary for us to get the asset ready for its intended use? Is the strike necessary? Okay, no, the strike is not necessary. So if we have striking for a few months and we have not been able to continue our construction, because that delay is not a necessary part of getting the asset ready for its intended use, it's a delay out of our control, okay? The asset would be constructed just fine without the striking. So the striking is not helping the asset in any way, okay? So in that case, we would suspend for the period where there is striking. Okay, so remember, we will want to ask ourselves, if we are capitalizing our borrowing costs and we have a delay, if the borrowing cost is suspended, if the active development of the qualifying asset is interrupted or delayed for a long period of time. So you need to ask yourself, is there a delay? Is the qualifying asset construction being interrupted? If it is, then you need to look at the reason for the delay. If the delay is due to a necessary part of getting the asset ready for its intended use, perhaps you are waiting for the cement to dry and you cannot step into the building for a week or two, okay? Or perhaps there is something you are waiting for in the building, like you're waiting for approval of plans, you're waiting for a technician to come out. That would be a delay that is necessary to get the asset ready for its intended use. So in that case, you will not be able to suspend the capitalization of the borrowing costs. However, if the delay is due to something like striking or something that occurs that is not going to help the asset get constructed, then if it is due to striking, then you would suspend capitalization until the striking is over. Okay. So let's have a look at, so we've looked at the commencement of capitalizing borrowing costs. We've looked at a situation where there is a delay and borrowing costs may need to be suspended. Let's have a look at the next slide where we look at when do we stop capitalizing borrowing costs. At some time in the future, this factory we are constructing is going to be ready, okay? This factory could be ready, and then we need to decide when do we stop capitalizing the borrowing costs, okay? So we will stop capitalizing the borrowing costs when the asset is ready for its intended use or sale, or is substantially complete and capable of being used or sold. Okay, we're going to look, I see someone has asked a question. This capitalization, what classification does it fall under? So you'll see just now when we look at our journal entries, we will have our assets and we will have our interest expense. And we will actually be taking our interest expense to our assets and increasing our asset value, okay? We'll have a look at the journal entries a bit later. But let's have a look at when do we stop capitalizing the capitalization of borrowing costs, okay? We will have a date that is called the cessation date. This will be when the asset is ready for its intended use or sale, okay? We are able to commence production, it is ready to be used, or perhaps we have built it and we decide it's more profitable to sell this asset. So if we have a situation where our qualifying asset is ready for its intended use and it is substantially complete and capable of being used or sold, we must stop capitalizing the borrowing costs, okay? So if you have a look at the note there, it says capitalization would cease if routine administration work or minor modifications are all that remains to be done, okay? So if we have a situation where we have completed the factory building and we just need to move some chairs in there and we just need to move some desk for the administrative staff, do you agree that having a kettle in the kitchen and having a desk there for the administrative staff, it doesn't prevent us from producing things in the factory, okay? So if there is just routine administration work, perhaps we need to get something signed off, someone needs to come and just do a sign off and an inspection, or perhaps there are minor modifications that remain to be done. Someone comes and they decide they don't like the pink walls in the office building, then they decide they want to repaint that white, okay? That is not preventing the factory from being used as it was intended. You can still produce the item you were going to produce in the factory, even if you don't have like a kettle in the kitchen and you don't have, you're not happy with the paint on the wall. So if the asset is ready for its intended use or sale, or substantially complete and capable of being used or sold, then you would have reached your cessation date, and at that date you must stop capitalizing the borrowing costs. Okay, so we've looked at what the definition of an asset was, what borrowing costs are, and we looked at what a qualifying asset is. When we have a qualifying asset and we have borrowing costs relating to that asset, we can capitalize these borrowing costs. And we looked at the commencement date of capitalizing the borrowing costs, and if there is a delay, when it would be suspended. Now we have just had a look at something called a cessation date, which is when the asset is ready to be used, we will stop capitalizing the borrowing costs. So Bento has asked, is the remaining borrowing cost expensed after the cessation date? That is correct. So what you'll see, we have our normal journal entries. We will debit our assets, credit loan, and then we will debit our finance expense and credit our loan. A portion of the interest expense after the commencement date, before the cessation date, will be capitalized. So whatever portion can be capitalized, we will debit debit the asset and credit the interest expense. And whatever portion may not be capitalized gets expensed in the normal way. Okay, so we will have a look at the example if you don't understand that. But the simple answer is the remaining borrowing cost expensed after the cessation date? That is correct. Okay, if we have finished our construction period, we cannot capitalize any more borrowing costs, then they will be expensed in the normal way. Okay, so let's have a look at the next slide. Okay, the next thing we need to consider is what type of borrowings do we have, okay? There are generally two types of borrowings we can have. We can have specific borrowings and we can have general borrowings, okay? So what do you think specific borrowings are? If you look at the name there, what do you think is the difference between specific borrowings and general borrowings? Can anyone just throw out an idea there? So what is specific borrowings and how is that different to general borrowings? Okay, so you're saying specific would be funds obtained specifically for the qualifying asset. Okay, that is correct. So we have our borrowings can come from two different methods. They can come from specific borrowings and they can be general borrowings. So if we have a first look at the specific borrowings, so specific borrowings are taken out for the sole purpose of financing the construction, acquisition, or production of a qualifying asset. Okay, so these borrowings will be specific to building that factory. If we decide to build this factory and we know it's going to cost us R1 million, they will go and get a loan for R1 million, and those borrowings will be specifically applied to building that asset. Okay, so when we have specific borrowings, we need to ask ourselves, how are we going to calculate the borrowing expense on these borrowings? Okay, so if we have a look at the next slide where we look at the measurement here. Okay, so when we look at specific borrowings, these are all borrowings incurred during the construction period, and these will be capitalized. Okay, so when we have specific borrowings, all our borrowings incurred during the construction period relating to our specific borrowings, these are going to be capitalized. If the funds are invested prior to the date they were utilized, we may have interest income, and this must be subtracted from the interest incurred. So an example of this would be if we are going to construct our factory and we decide on the 1st of January, this construction is going to cost R1 million. So we go to the bank and we get our specific borrowing facility for R1 million. Okay. If we only have to pay the construction workers in 6 months' time or in a few months' time, so if we are incurring these expenses, but we only pay them like at the end of the month, maybe the end of 3 months, then what are we going to do with the borrowings? Okay, we are going to invest the borrowings. We can invest the borrowings, that money we have gotten, into our bank account, into, say, a fixed deposit, and we can actually earn interest income for the period which we have not paid the borrowings and we are holding the borrowings in our bank account. Okay, so all you need to know is that when we take out a loan, we have interest expense. When we receive that loan, it's going to go into our bank account. We're going to go debit, bank, credit, loan. And then we're going to start paying money out of our loan. but the whole amount is not going to be paid at the beginning. So that money is sitting in our account and it could earn interest income. So when we look at how much borrowing costs do we capitalize, we need to subtract any interest income that was earned. Bento has asked, but what if the interest income is greater than the interest expense? Do we still capitalize the profits? Okay, my question to you is, I'm not sure if you know anything about banks, but if you invest money in the bank, you'll be lucky if you get 4% these days, okay? Interest income. However, if you want to go to the bank and take a loan, they will charge you at least 6 or 7% on that loan, okay? The borrowing rate is always higher than your investment rate. It's how the bank makes a profit. So if we take a loan from the bank of R1,000,000 and they could be charging us like 10% interest, then if we take that loan and we invest it in a fixed deposit or in some kind of short-term investment, the interest income will never be greater than 10%, okay? It's how the banks will make money. They will make their money. They will charge you higher interest expense than what they would give you when you're investing money, because the difference between your interest expense rate and your like interest income rate, that's the profit that the bank gets, okay? So you're unlikely to be in a situation where your interest income is greater than your interest expense relating specifically to that loan. Okay, that is a good question though. I can see you are thinking nicely. So when we have specific borrowings, we said that all borrowings incurred during the construction period are going to be capitalized. And we said that if we are able to invest the funds before we have to pay all of our construction workers, any investment income earned must be subtracted from the interest incurred. So we're basically going to take the difference between our interest expense and our interest income on our specific loan, and we are going to capitalize that net amount, okay? Sometimes we will have investment income and sometimes we won't. It just depends when we get the loan and when we need to pay the construction workers, okay? But usually that investment income is not bigger than the interest expense. So let's have a look at an example. Finally, we have gone through a lot of the ideas, and I think it's best we attempt an example to see if we can put all of our theoretical ideas into practice. So let's have a look at this class example. HPTY Limited borrowed 500,000 from the bank on the 1st of July 2012 to construct a building. They have told you that this building meets the definition of a qualifying asset. So construction began on the 1st of July, and the interest payable on the loan was 10% per annum. The company paid construction costs of 400,000 on the 1st of September. Surplus funds were invested in a fixed deposit and earned interest at 6% per annum. No portion of the loan was repaid during the year ended 30 June. Okay, so let's draw a timeline. The best thing to do would be to draw a timeline just to make sure we understand. Okay, it's not going to be too straight, but I'll do my best. So here we have the start of our timeline. We are borrowing 500,000. Okay. Okay, we're borrowing 500,000 on the 1st of July. Okay, it's a lot harder to draw than I thought it would be here. So this is the 1st of July. So we have borrowed 500,000. Okay, I'm not sure if you can even read this. I'm struggling myself. So this is the 1st of July. We have borrowed 500,000 and construction began on this date. So I'm just going to say construction. Okay, construction began on this date. Interest payable on the loan is 10%. So we know that we borrowed 500,000 from the bank on the 1st of July. We begin construction on that date. The company paid construction costs of 400,000 on the 1st of September. So we have 1 September. Okay, and we paid construction costs of 400,000. So surplus funds were invested in a fixed deposit and earned interest at 6% per annum. And they told us that no loan was repaid. Okay, so 1st of July 2012, that is the beginning of our period. And our end of our period is 30 June 2013. So they're asking us to calculate the borrowing cost to be capitalized for the year ended 30 June 2013. Okay. So we need to ask ourselves, how much are we going to capitalize? Okay. So I apologize for the rough timeline. So let me ask you this. What is our borrowing costs incurred for the period 1st of July 2012 to 30 June 2013? What is our borrowing cost for that period? So how do we calculate our borrowing costs? Remember, a cost, this is your interest expense. So we are going to take the amount we have borrowed of 500,000 and we're going to multiply this by the interest of 10%. And this will give us interest expense of 50,000. Okay, so we took the loan of 500,000 on the 1st of July 2012. We have been told that no portion of the loan was repaid during the year ended 30 June 2013. So we know that our balance of our loan was 500,000 for the whole year. So our interest expense is going to be calculated by taking the 500,000 and multiplying it by the 10%. So you are correct. 50,000 is correct. That is going to be our interest expense for the period. Now, my next question to you is, remember when we said that we can capitalize our borrowing costs because we have a qualifying asset, but we said when we have invested a portion of this money to earn interest income, we have to subtract the interest received. Yes, Madeir has gotten it completely correct. We need to calculate our finance costs, which we did, of 50,000. But now we need to determine what is our interest receivable going to be, okay? And this might be a bit more tricky. So who can calculate the interest expense for me? And we'll see who gets it right. Who can calculate the interest expense? The next question I need to ask you, did we invest the full 500,000 for the year, or did we pay construction costs during the year? So if we have a look from the period 1st July to 1st of September, we could have invested 500,000 earning interest income. Sorry, that was supposed to be a 5. So we invested 500,000 here, earning interest income for a period of 2 months, July and August. And then we paid 400,000 of this 500,000 back. So during the period 1st September to 30 June, we only would have had 100,000 left to invest in our fixed deposit. So we need to break this calculation down, okay? So when we look at our interest expense from 1st of July 2012 to 1st of September, we are going, how much are we going to invest, okay? We took a loan of 500,000 on the 1st of July. We only paid our construction costs on the 1st of September. So we are able to invest the full 500,000 for 2 whole months, earning interest of 6%. Okay, so we're going to go 500,000 times the interest income rate of 6. And then remember, that is the annual interest rate, but we are only investing this amount for 2 months of the year. So that will give us, let me just calculate it. So that will give us 5,000 Rand for the period 1st of July to 1st of September. So do you agree from the 1st of July to the 1st of September, we are going to earn interest income of 500,000? Is that correct? Or did I make a mistake? Okay, it is correct. So we've invested our 500,000 from 1st of July to 1st of September. On 1st of September, we are now going to pay 400,000 Rand out to our construction workers. So now we only have 100,000 Rand to invest. So now we're going to invest that 100,000 from 1st of September to end of the period, which is 30 June. So we're going to invest 100,000 and our interest rate is still 6% per annum. And who can tell me how many months that is for? So September, October, November, December, January, February, March, April, May, June. That is for 10 months. So we're going to multiply it by 10 divided by 12. And that is going to give us 5,000 Rand. Okay. So our interest income that we have earned for this period is going to be 5,000 Rand from 1st of July to 1st of September and another 5,000 Rand from 1st of September to 30 June. So are you all happy that our interest income is going to be 10,000 Rand for that period? Do you guys all agree with me? So then if we look at the amount we can capitalize, how much are we allowed to capitalize now to our qualifying assets? How much can we capitalize to our qualifying assets? Correct, we can capitalize 40,000. So let's just have a look at this breakdown. The workings are a lot neater than mine. So we have our borrowing costs incurred, and you all agreed that was 50,000, but we cannot capitalize just the borrowing costs because we have incurred interest income on these borrowing costs of 10,000 Rand. So if we take our borrowing costs on our specific loan and investment income on our specific loan, we can see we get a net amount of borrowing cost of 40,000, and this is the amount we can capitalize. Okay, so let's carry on. Let's go to our journal entries now and see how are we going to record the capitalization of these amounts to our qualifying asset. So we want to record our journal entries. So do you agree? At 30 June, we have paid 400,000 Rand to our assets. Okay, we have borrowing costs. We are building our asset here. So because we have paid our borrowing cost of 400,000, this is the loan amount. We are using this loan to build our assets. Okay, so we would have gotten the loan from the bank. And now we are paying 400,000. We are debiting our asset with the amount we have paid to construct this asset so far, and we are crediting our bank. Okay, so they don't seem to show the journal entries relating to the loan, but you could also say debit bank, credit loan of 500,000. And then 400,000 of that will be paid and would have been would have made your asset. So capitalize means capitalize is basically the opposite of expense. So when you expense something, you're expensing it and that amount is disappearing. If I go to the shops and I spend 100 Rand on chocolate, I'm expensing that amount, so I'm not going to see it again. Whereas capitalize means you're like generating a new asset, okay? So yeah, capitalize means it's not going to, it's expense, but you can use that money because you're building a bigger asset. Okay, so we're going to debit buildings of 400,000 and credit bank. Then we have our finance costs, okay? And the capitalization will happen here at the end, okay? The capitalization is the last journal entry. So you agreed we have finance costs of 50,000. So we're going to go debit finance costs because it is an expense. And we're going to go credit bank or our liability of 50,000. So we can either pay the finance costs with our bank or our loan will be getting bigger. So we'll debit 50,000 finance costs and credit our bank. Okay, that is our finance costs. Then we have our interest income. And remember, we invested a portion of the loan to earn interest income. And we said it was 10,000 Rand. Debit our bank or interest receivable of 10,000 and credit our interest income. Now we need to ask ourselves, what portion of this interest can we capitalize to our assets? So remember we said we can capitalize 40,000 because this is the difference between the borrowing costs and the investment income. So we're going to go 50 minus 10, which is 40, and we're going to capitalize it. So this is where the capitalization happens over here. So we are capitalizing our interest expense of 40,000 to our asset. This is where the capitalization will happen, okay? So have a look at these journal entries and see if you understand them while I just have a look at the chat. Okay, so someone is asking here, what is the portion of the loan that was repaid during the year? Remember, they told us in the question that no portion was paid. And then if we have a look at the next question, how am I going to calculate the depreciation amount if we have been asked to calculate depreciation? So remember, when you calculate depreciation, you will only begin depreciating an asset when it is available for use. So when the asset is ready to be used, all the borrowing costs and construction would have been completed. Then it becomes available for use, and then you depreciate on that day going forward. So the depreciation will be your total amount of your asset. So you would add up all of the amounts you have spent on the asset and all of the interest expense you have incurred on the asset. Okay, so someone has asked, why are you calculating interest using 500,000? Because it is not a surplus. So remember, if we go back to our timeline here, we got 500,000 Rand on the 1st of July 2012. I think my timeline got deleted. So from 1st of July to the 1st of September, we had 500,000 Rand that we invested for 2 months. So the interest income will be on that 500,000 Rand because we got the loan of 500,000 on the 1st of July and we only paid on the 1st of September 2012. So for 2 months, that 500,000 was invested. Then once we paid the construction cost of 400,000, we have 100,000 left, and that was invested for 10 months. Okay. So that is about the interest income. So it says in the question there, if we go to the class example, it says surplus funds were invested in a fixed deposit and earned interest of 6% per annum. So surplus funds are funds that we don't need currently for this asset. So when we received 500,000, we were only told we needed to pay 400,000 on the 1st of September. So for those 2 months, the full 500,000 was considered surplus. So we didn't have to use this amount immediately for the construction costs. So they were building, and then we had to pay them at the end of the 2 months they had worked. So for that period, 1st July to 1st of September, the surplus funds are 500,000, okay? And then from the 1st of September to 30 June 2013, the surplus funds are 10,000 or 100,000, okay? So someone is asking, what if a portion of the loan was repaid during the year? If the portion of the loan was repaid, then obviously our interest expense would change because our loan amount is changing. Okay. Then let's have a look at the next question. So assume we invest the funds when we receive them. Okay. We're not assuming. If you have a look over here where I've highlighted, it says surplus funds were invested in a fixed deposit and earned interest at 6% per annum. So we're not assuming. We were told that our surplus funds were invested. So from 1st of July to 1st of September, our surplus funds were 500,000. From 1st of September to 30 June, our surplus funds were 100,000, which is the difference in the 500,000 and the 400,000. Okay. So someone is asking, how did we find the 10,000? So if we have a look at this slide here, the 10,000 was our interest on the period for 2 months. So if you take the loan amount, this is our surplus funds for the period 1st July to 1st of September at 6 months. And that will give you 5,000, okay? And then if you add that to the surplus funds between 1st of September and 30 June, that will give us 100,000 surplus funds, and that is for a period of 10 months. So someone is asking, how do you know that the 500,000 is surplus? Okay, well, they told us there that we borrowed 500,000 from the bank, meaning we're getting 500,000 into our bank account. Then they told us in the 4th bullet point that the company is going to pay construction costs of 400,000 on the 1st of September. So our surplus funds are any money that is surplus that we don't need right now to pay our construction costs. So our 500,000 is our surplus funds for the 2 months. And then once we have paid the construction costs of 400,000, our surplus funds are 100,000 there. Okay. So I hope that answers all the questions. And then we had a look at our journal entries. Okay. And you saw that we're still going debit finance costs, credit bank. Okay. This is showing our interest expense, and this is showing our interest income. And then you'll see the difference between these two amounts is going to be the amount we capitalize. So we're still charging our interest expense, but then here we will decide once we have calculated what our net borrowing costs are. Okay. Someone, DC Hart, is saying, yes, we did borrow 500,000, but the scenario never said we invested the money immediately when we got it, okay? But remember, if you go to the scenario says that any surplus funds were invested in a fixed deposit and earned interest at 6% per annum. So the surplus funds, the funds were considered surplus from the first day we got them because we didn't need them. So surplus funds are any funds you don't need immediately. They are surplus to the business. So by them telling us surplus funds were invested, then we received the money on the 1st of July. So they were surplus from that date. Okay. Okay, so I said for the journal entries that you could have actually had another journal here. I would have gone debit bank of 500,000 to show the money coming in. Okay, you could have also said that. So debit bank 500,000. This is showing the loan that has been received by us. And then you could have gone credit loan. Okay. Not sure why the slides don't have this, but I think it's just showing the journal entries relating to the actual assets. Okay. So you could have shown the journal entries relating to the loan, debit bank credit loan. That is correct, MJ. So let's move on. If you're happy with the journal entries, let's have a look at a slightly different example. Okay, let's have a look at class example 2. Someone is asking about the surplus funds. Surplus means after we paid the construction funds, the amount we have left over. But you have to understand, for the 2 months, we receive that money into our bank accounts. If I pay you 20,000 Rand and you know you only have to pay your rent and pay your varsity fees of 15,000 in 2 months' time, for 2 months, that money is sitting in your account as surplus. And it's the same situation here. So surplus doesn't mean after we paid the construction funds. Surplus funds are any funds in our bank account that we don't need immediately. So the loan was received of 500,000 on the 1st of July. We only really needed it on the 1st of September. So for those 2 months, the 500,000 was surplus. Okay. So let's carry on to the next example. I think you have asked all the questions available. Okay, sorry, my computer's just frozen currently. There we go. So now we have another example that is similar to the first example. So same information as for class example 1, except here the construction begins on the 1st of August. All criteria for capitalization are met on the 1st of August. Calculate the borrowing cost to be capitalized for the year ended 30 June. Okay, so it's the same information as class example 1, except now construction is not beginning on the 1st of July, it is beginning on the 1st of August. And then they've told us there all criteria for capitalization are met on the 1st of August. So we can only start capitalizing our interest expense from the 1st of August because this is when all the criteria are met. Okay. So they want us to calculate the borrowing cost to be capitalized for the year 30 June 2013. Okay. So I'm not sure if you have the information in front of you, but let's go to our class example and we'll just discuss it. So here they're telling us all the information is the same, except here construction began on the 1st of August. And they're telling us that all the criteria were met for the asset to be capitalized on the 1st of August. Okay. So now I want to ask you, what is our interest expense? Can someone calculate what our interest expense is for class example 2? And remember, class example 2 is using the same information here, except the construction began on the 1st of August. And all criteria for capitalization are met on the 1st of August. So we have our timeline again. And here, so we have our loan of 500,000 from the bank on the 1st of July. However, our construction only began on the 1st of August. So who can tell me what the interest expense is now? Okay, I see some of you are getting it correct. So remember, in our timeline here, we have the loan from the 1st of July. From the 1st of August, we have started construction, and only from the 1st of August are we able to capitalize our interest expense. Okay, so maybe my question was a bit vague. We will have two different things for the year. We will have our finance costs relating to the loan, and then we will have the portion of those finance costs that are able to be capitalized to our qualifying assets. Okay, so do you agree? We still took the loan out on the 1st of July. So if I ask you what is our interest expense for the year, regardless of how much we are able to capitalize, do you agree that our interest expense is 50,000? Okay. Remember when we looked at the journal entries, we saw we had our interest expense, and then a portion of that interest expense will be capitalized. So we took the loan out from the 1st of July. So from this date, our interest expense is going to be incurred. However, only from the 1st of August are we able to begin to capitalize the interest expense. So if I ask you, what is our interest expense for the period relating to the loan, we are going to go 500,000 times 10% for the year, and that will give us our finance costs of 50,000. But remember, I'm going to ask you now, what portion of those finance costs can we actually capitalize? We cannot capitalize the full year because the construction only began on the 1st of August. If we have a look at class example 2, the construction only began on the 1st of August, which means only from this date are we able to capitalize our borrowing costs. So even though our interest for the period is 50,000, we are only able to capitalize 11 months of that. Okay, so it is 500,000 times 10%. And then if we count from 1st of August to 30 June, that is 11 months. Okay, so the interest expense we can capitalize is 45,833. Okay, so that is interest expense that we can actually capitalize. Okay, are you guys all happy with that idea? Okay. Then the next question is, now that we have calculated our interest expense, what is our investment income going to be? Remember, we have surplus funds now from a certain period. Okay, so previously we got the loan of 500,000 and we received this on the 1st of July. But because construction only began on the 1st of August, the interest income can only be considered when we look at the capitalization from the 1st of August. Okay, so we will have investment income still of 10,000 Rand. However, because our construction only began on this date and all criteria for capitalization were met on this date, we have our interest income for 2 periods. Okay, so let's do the calculation for interest income together. So we have our loan of 500,000, even though it was received on the 1st of July, and interest income will be accrued from this date. The portion of interest income to be set off against the interest expense to be capitalized can only be taken from the 1st of August. So 500,000 times 6% times 1 divided by 12. So this is for the 1 month, August, and then September we paid our 400,000. So this is going to give us interest. Let's just calculate it. This is going to give us interest of 2,500. This is from 1st of August to 1st of September. Okay. So then we have, so this is for the 1 month period. Then we obviously pay our construction costs of 400,000. So this is going to give us 100,000 left in surplus cash that we can invest. So we're going to multiply this by 6%, which is our investment rate. And from 1st of September to 30 June, that is 10 months, okay? So that is going to give us interest of 5,000 Rand, same as the previous example, okay? So then when we add our interest income together, we are going to take the 2,500 interest income in our capitalization period plus our 5,000. So that is going to give us 7,500. Okay. So can you see how this example is different to the previous example? Because our construction began 1 month after we received the loan, it means we can only, any interest expense and investment income relating to the capitalization can only take place from the 1st of August. So let's go to our journal entries and where this calculation is in your slides. Okay, so here, remember we had class example 2, the construction begins on the 1st of August, not the 1st of July. So here we have our borrowing costs, 500,000 times 10%, and it was only for 11 months from 1st of August to 30 June. Then we have our investment income earned during construction. Even though we received the money on 1st of July, the interest income relating to the capitalization of borrowing costs can only start taking place from the 1st of August. So we're literally counting 1 month where we had surplus cash of 500,000, and then we paid 400,000 to our construction team, and then we had surplus cash of 100,000 left, and that was for 10 months. Okay. So if we take our borrowing costs less our investment income, this is going to give us an amount to capitalize of 38,333. Okay. Are you guys all happy with that? Okay. So let's have a look at our journal entries now. So someone is asking, why didn't we invest the 500,000 on the 1st of July when we received it? Okay, and that is a good question. We did invest it, and you'll see when we do the journal entries, we did receive interest income for the 12 months, but because we hadn't started construction on the 1st of July, we cannot include that 1 month from the 1st of July to the 1st of August when we are looking at calculating our capitalized borrowing costs. So remember, this interest expense here must be for the construction period, and as well as the investment income. The investment income here is for the construction period. So even though we have interest expense of 50,000 relating to the loan, we can only capitalize 45,833. And it's the same with the interest income. Even though we would have received interest income for 2 months and then 10 months, which would have given us 10,000 Rand, because the construction period only starts on 1st of August, that is the capitalization period. So we can only include investment income here relating to the construction period. Okay, let's have a look at the journal entries, and I think it'll make a lot more sense. Okay, so what are the journal entries for the reporting period ended 30 June 2013? So again, we have our building, our asset of 400,000. So this is the amount that goes towards our asset. We would have paid that amount, okay? And just like the previous example, you could have gone debit bank of 500,000 and then credit your loan, okay? So it's not wrong to do this journal entry. They just seem to be focusing on the journal entries relating to the asset. So you could have gone debit bank 500,000 and then credit your loan. Okay, I apologize. My handwriting is a lot neater when I use a pen. Okay, so we have our building asset, 400,000. We can capitalize this because we have incurred it and we will pay this amount out of the loan we have received. Okay, now here where you might be a bit confused. We are debiting our finance expense account of 50,000 and we are crediting our bank and liability account with 50,000. Do you agree with this? This is our finance cost for the year, okay? We calculated it by taking our 500,000 multiplied by 10%. That gives us 50,000. This is our finance cost for the year. We got the loan on 1st of July and we had it for the full year. Then our interest income is 10,000 Rand, okay? We got the loan from 1st of July. We had surplus cash of 500,000 Rand for 2 months. And then on the 1st of September, we paid 400,000. So we had surplus cash then of 100,000. So our interest income for the year is 10,000 Rand. However, if I ask you, what amount of net finance costs can you capitalize to the asset? It is not the difference between these two, okay? You cannot capitalize 40,000 like we did in the previous example, and the reason for this is that the construction only began on the 1st of August. So, and they told you there all criteria for capitalization was met on the 1st of August. So even though we have this amount of 50,000 as finance costs and this amount of interest income of 10,000 Rand, we cannot capitalize the difference between these two because a portion of this was received or incurred outside of our construction period. So if we want to ask ourselves, what is the amount we can capitalize? If we go back to our calculation here, we can only capitalize the interest expense for 11 months because our construction period started 1 month after we got the loan. And the same here, even though we invested the funds of 500,000 for 2 months, before we paid the 400,000, we can only include the 1 month that was in the construction period. Okay. It may sound a bit confusing, but I think if you go through these examples again, you will understand. So this amount here came from that calculation on the following slide. So someone is asking, why don't we use the 45,833 and the 7,500 in our journal entries? So we are using the net of that amount here, but if I ask you, is the 45,833, is that our interest expense for the year? No, it's not. Our interest expense is 50,000, but the interest expense that we can capitalize to our asset, that is 45,833, but it is not our total finance costs for the year. Our total finance cost for the year is 50,000, and our total interest income is 10,000. Then what you have given me empty, those are the amounts of the finance costs and of the interest income that we can capitalize, but it is not the full finance costs. Okay, the full finance cost for the year is 50,000 and the full interest income is 10,000. That is the full finance cost and full interest income. But when I ask you what portion of that can be capitalized to our asset, to our qualifying asset during the construction period, then you would tell me, well, 45,833, that was incurred during the construction period, and then the interest income of 7,500, that was incurred during the construction period. So the net of those two is the amount we can capitalize to our assets. Okay, so someone is asking, why don't we write a finance charge of 45,833? This number here represents the 45,833 less the 7,500. Okay, you could show it separately, But if you're pushed for time in an exam, then you are recording the net of the two amounts. So it makes sense just to record it at the net, which is the finance cost less the investment income. Okay. Do you guys understand? I think it would be useful for you to go through the slides again and go through the example again. Okay. Someone is saying not really. So what do you not understand? This part might confuse you, but you have to understand that not all finance costs can be capitalized and not all interest income can be capitalized. You can only capitalize the portion during the construction period. So even though we had finance costs of 50,000, this is a cost that we will have to pay the bank for borrowing the money. It's a reality, okay? They don't really care when we used it. That is the amount we are paying the bank, 50,000. And then we're investing the surplus cash, which we get investment income of 10,000 Rand. That is the amount we get. But when I ask you what is the amount we can capitalize to our assets, it is not the difference between these two amounts because not all of it was incurred during the construction period. Remember at the beginning of the lecture, we went through what is the criteria when we can commence capitalization of borrowing costs. We can only commence capitalization of borrowing costs when activities are underway to prepare the assets, when expenditure is being incurred, and when borrowing costs are being incurred. So capitalization is only allowed on the 1st of August, which is why we can't take the difference between these two. For 1 month in there, we weren't allowed to capitalize, and 1 month in our interest income, we weren't allowed to capitalize. So someone is asking, we did record 100,000 as interest receivable. That means we did invest 500,000 from the 1st of July, but we will only capitalize 7,500 because construction began on the 1st of August. That is 100% correct. We did invest the 500,000 Rand on the 1st of July, but because the construction only began on the 1st of August, and that is when they told us we are allowed to capitalize it, we will only capitalize 7,500. Okay, so there are still some questions here. I'm going to explain it once more, and then I think you can email me and we can set up a consultation. Okay, so if I ask the people DRJ and O, what is our interest income for the year? How much is the company receiving from the invested cash? Okay. They are receiving 10,000 Rand. They invested the amount from 1st of July to 1st of September. So that was 500,000 Rand. Okay. Times it was for 2 months. And then that was at an interest rate of 6%. And that gave us 5,000 Rand. Okay. Then, after we paid the construction cost of 400,000, we had 100,000 left, and we invested that for 10 months, and that was at 6% per annum. Do you agree? Okay. We invested the amount of 500,000 from the 1st of July, and then we had surplus cash of 100,000 on the 1st of September, and we invested that for 10 months. The 10,000 Rand, this is the actual interest income. This is the actual interest income that the company has received, okay? But if I ask you what portion of that interest income was incurred during the construction period, what will you say? If I ask you how many months of that year was capitalization allowed, you should tell me 11 months, okay? From the 1st of August to the 30th of June. Okay, so 10,000 Rand was the actual interest income. The company received this amount, but what portion of that interest income can be capitalized or netted off against the interest expense? And I'm hoping you'll tell me it will be the 11 months from August to June. Okay. I hope that explains it. If not, you're welcome to email me and we can set up a private consultation, or you could chat to your tutors. So someone is saying payments of construction will include that. It may or may not. You will just have to look at what the information tells you. Okay. Usually, if the company is a VAT vendor and your construction company is a VAT vendor, then yes, you will have the income VAT. Okay. I can see some light bulbs are going off and you are understanding. Let's carry on, guys. Let's not get stuck here. We still have some more work to do. So remember we said that our borrowings for our construction can come from two different places. They can come from our specific borrowings, and we said that our specific borrowings were all borrowings incurred during the construction period, okay? Then we need to move on to general borrowings. Okay, what are general borrowings? These are funds that are entered into for a general purpose. So these funds may be utilized for a multitude of purposes, in addition to the construction, acquisition, or production of a qualifying asset. Sorry, do you want to ask a question? Lithicom, you can ask a question. Sorry, I didn't see your hand. You can unmute your mic if you want.
Ma'am?
Yes?
Ma'am, can you hear me?
Yes, I can. Can you hear me?
Yes, ma'am. Can you please go back, I think 3 or 4 slides?
Yeah. Tell me when to stop.
The one before,
Is
yes,
it this?
this one.
Oh, wait. Yeah.
Yes, this one, the column where we're calculating borrowing. Yes. I wanted to ask, why is it that borrowing costs incurred during construction, which I understand is 11 months out of 12 months, because the construction process, we invested the 500K, while we had a surplus for 1 month before we started construction, right?
Yeah. Well, okay, let me
So
explain
the
it
11
this
months is
way.
the duration of the construction.
So we got the loan of 500,000, okay? Do you agree we got this loan on the 1st of July? So we
Yes,
got this
ma'am.
loan on the 1st of July. So our actual interest expense is 50,000, but we can only capitalize that portion relating to the period of capitalization. And it's the same here. We had that 500,000 Rand from the 1st of July, so it would have been surplus from that date. But so our interest income for the year is actually 10,000 Rand, but we can only include the portion that related to the construction capitalization period. Does that make sense?
Ma'am, I hear
Yes?
you, but what I don't understand is that why in that same block that you're at now, why is it 500,000 times 6% times 1 over 12 months, which I understand is for the 1 month before construction, right?
No, this
And
is the
then
1 month
and then
after
the next line it
construction.
says 500,000 minus 400,000. But haven't we
This
paid
one,
the 400,000 already when we started
no,
construction?
okay, I'm going to explain this. The 400,000 was paid on the 1st of September. This 1 month is from 1st of August to 1st of September. Okay. So I don't want to get stuck here and make the whole class wait, but
Okay,
how
then.
I can explain this is that this 1 month is not July, this 1 month is August. So from 1st of August, all capitalization criteria were met. So the 500,000 was surplus for 2 months, but we can only include the 1 month here because that relates to the capitalization period. That 1 month in July before capitalization criteria were met, that cannot be included in this calculation. Okay, does that make sense?
Yes, ma'am. Thank you. I understand perfectly.
Okay, if you're still confused, you're welcome to email me and we can set up a consultation. Okay. Okay, guys, let's carry on. We're taking up all of the time here, but let's go to our general borrowings. So we looked at our specific borrowings and we said those borrowings were specifically related to the construction of the assets. If we have a look at general borrowings, this is general borrowings like it suggests, okay? Not all interest incurred is directly attributable to the qualifying assets. So if we have a look at the next slide, sorry, the previous slide, we said general borrowings, these are funds entered into for a general purpose. So they can be utilized. A portion can be utilized for construction. A portion can be utilized for something else. Okay. So if we then go on to the next slide, we need to know how do we treat the interest relating to these general borrowings? Because not all the borrowings are going to be used for the construction of the qualifying asset, not all the interest incurred is directly attributable to the qualifying asset. So therefore, not all the interest on a general loan may be capitalized to the assets. Okay. So we need to calculate something called the weighted average cost of borrowings. So because it is general borrowings, not all of it is going to be used for the construction of the asset, which means not all interest on the general loan may be capitalized. So we need to determine what portion can we capitalize, and we are going to determine that by calculating a weighted average cost of borrowings. It sounds complicated, but it's actually not. What is a weighted average? Okay, it is basically an average. Okay, I'm not sure if you guys do like cost accounting, financial management. I'm not sure if you have covered something called the weighted average cost of capital. This calculation is very similar. You are basically calculating the average cost of your borrowings. Okay, so let's have a look at the formula here for calculating our weighted average cost of borrowings. We're going to take our interest incurred on general borrowings for the year, and then we're going to divide it by the weighted average total general borrowings outstanding during the period, okay? And then we're going to multiply this by the expenditure incurred on the qualifying asset. It sounds very complicated, but when we have a look at an example, I think it will be quite clear. But we basically want to calculate the weighted average interest, and we'll take that as a percentage of the weighted average general borrowings. And that will give us something called a capitalization rate, okay? Then we will apply that capitalization rate to the expenditure incurred on a qualifying asset. Okay, so this is the definition. I think the easiest way is to have a look at an example where we can use our definition here. Okay. So let's go to the next slide. Here, BPTY Limited had R500,000, 7% existing general loan outstanding on the 1st of January 2012. An additional loan of 600,000 was raised on the 1st of January 2012 at an interest rate of 12.5%. And they are telling you here that the loan is not specific to the project. So both of these loans here are general loans. Okay, we have two general loans. No repayments were made on either loan during the year. Construction on a building, i.e. a qualifying asset, began on the 1st of January 2012. The following payments were made from the loan. Calculate the borrowing cost to be capitalized for the year ended 31 December 2012. Okay, so if I ask you to calculate the weighted average interest for the year, can anyone throw out an amount there? Okay, so construction began on the 1st of January. Construction began on the 1st of January, and they are asking us to calculate the borrowing costs on 31 December. So that is for 12 months. 12 months is our capitalization period. So the first thing we need to do is to calculate what is our weighted average interest, okay? So what is our weighted average interest? And remember here we have two loans. So we're going to take our 500,000 times 7%. And if you calculate that, 7% of 500,000, what do you guys get? Okay, you get 35,000. That is correct. So that is our interest relating to this first loan over here, this first general loan. Then we need to have a look at the second loan. So we have a general loan of 600,000 times 12.5%. So what is the interest if we take 12.5% times 600,000? Okay, it is 75,000. So here we have calculated our interest relating to each loan. So now we need to calculate what is the total interest on this general loan. Okay, our total interest, oh sorry, I left off a 0 here. So our total interest is 110,000, okay? That is our interest incurred on our general borrowings. So our aim now is to calculate a capitalization rate. So we have calculated the total interest on the general borrowings, but now we need to calculate what is the total borrowings for the year. What is the total general borrowings for the year? So we have a general loan of 500,000 and we have an additional loan of 600,000. So what is our total borrowings? Our total borrowings is the addition of these two being 1.1 million. Okay, you have to count your zeros. It is 1.1 million. So we have our total interest incurred on the general borrowings of 110,000. And then we have our total borrowings of 1.1 million. So if we take the interest incurred here as a percentage of our total borrowings, that is going to give us a capitalization rate of 10%. Okay, are you guys all happy with that? So this is the capitalization rate we are going to use when we decide how much we can capitalize to our qualifying asset. The reason we do it this way is that we have general borrowings, okay? We have this loan and we have this loan. So we need to calculate a weighted average capitalization rate, which is basically weighted according to the total borrowings outstanding during the year. So we've calculated our total interest on our general borrowings being 110,000, and then we calculated that as a percentage of our total borrowings outstanding. So that is going to give us a capitalization rate of 10%. Okay. Now we're going to take that capitalization rate and we're going to calculate how much can we actually capitalize. So remember, if we go back to our example here, it said the following payments were made. So out of our general borrowings, these payments are going to be made. We cannot calculate the capitalization rate as a percentage of these general borrowings here because not all of it is going to be used for the construction of our qualifying assets. So we are going to take the following payments. This would have been paid from our general borrowings. But remember, we can't use all of our general borrowings because some of it's going to be used elsewhere in the company. So we can only capitalize that portion of the amount we have used out of our general borrowings. Okay. So we calculated our capitalization rate at 10%. And we had expenditure out of our general borrowings on the 30th of April 2012 of 350,000. So out of our general borrowings, we took 350,000 to pay for the construction of our qualifying asset. And we are going to multiply this by our capitalization rate of 10%. And if we have a look at the time period, we paid it out of April. So 30th of April, May, June, July, August, September, October, November, December. So we took this amount out of our general borrowings on the 30th of April. So we essentially are borrowing it for 8 months of the year, okay? So we are calculating the borrowing cost to be capitalized for the year end. We really only borrowed the 350,000 from the 30th of April. So from the 30th of April, we will calculate our interest at our capitalization rate. Okay. So you guys are happy? We're taking the 350,000 because this is the amount out of the general borrowings that are going towards the capitalization and construction of the qualifying assets. And we're multiplying this by our capitalization rate. And this is for 8 months. We took this out of our general borrowings on the 30th of April. So if we calculate the period that we are capitalizing this, it is for 8 months. Okay, let's just go to the previous slide. So this was our capitalization rate over here that we calculated, that we are using in the example. And then if you have a look, so this is the amount of the general loan, but it's not the amount we're applying in the construction of the assets. So these are the amounts we are actually taking out of our general borrowings. We are essentially borrowing from our general borrowings. Okay, so that was our capitalization rate, and that is the amount we used in our calculation. Okay, if we have a look at, so we have payments made on the 30th of April, then we have another payment made on the 31st of August. So from the 31st of August, we are paying out of general borrowings of 600,000. So from this date, we are taking on a further 600,000 out of general borrowings, and we're going to pay it over to the construction workers. And we're going to multiply this by a capitalization rate of 10%. And we took this amount out of our general borrowings on the 31st of August. So if we count how many months that is, September, October, November, December, it is 4 months until the end of the year. Okay, so that is going to give us this is the amount that we can capitalize to the qualifying assets, okay? And we do it differently here because this is general borrowings. The loan is going to be used for different amounts. So we have to calculate a capitalization rate. This is the rate we apply to the amount we take out of our general borrowings, okay? So this is the amount we are going to capitalize under our general borrowings over here. So they told us in the question that construction on the building began on the 1st of January. MT is asking if our construction dates change, then our rate will change too. Our rate won't change, but the period here will change, okay? Okay, guys, let's carry on. We're running out of time here. So let's have a look at our journal entries. We have our building asset. This is the total of the two amounts. This is the payment of 350 and the other payment of 600. So 350 plus 600. That is going to give us the 950,000. Then we have our finance costs. So this is our actual interest expense for the year. So this comes from the slide where we calculated our capitalization rates, okay? So it was the interest for the period of 110,000. But remember, this is the total interest on the general borrowings, but we cannot capitalize this full amount because they are general borrowings. Not all of the borrowings is going to be used for the construction. So only when we take the amounts out of general borrowings, we're kind of borrowing from our general borrowing pool, then we can capitalize the interest expense. Okay, so this is our actual interest. The 110,000 is our finance cost. This is our interest expense for the year relating to our general borrowings. But what portion of this can we capitalize? We cannot capitalize this whole thing because a large portion of this will relate to borrowings for other things besides construction, okay? Maybe they took a loan to have a party, maybe they took a loan to pay bonuses, but a portion of this loan and interest is going to relate to other things besides construction. So we cannot capitalize the full amount of finance costs. We can capitalize, though, the portion when the money was taken out of the general borrowings, okay? So this amount here comes from the previous calculation. It comes from here. And this is the total when we applied the capitalization rate to the amount we took out of general borrowings from the date it was taken. Okay, are you guys all happy with this idea? So we have to calculate a capitalization rate because we have general borrowings. We have more than one general borrowings. So we calculate a weighted average, similar to what you would do in math to calculate your weighted average cost of capital. It is a similar concept, okay? So then if we have a look at our journal entries, so someone is asking, why did we use the 950,000 and not the 1.1 million? So the answer to that is that 1.1 million, that is the general loan we took, but it is not the amount we used to construct the assets. The amount we used to construct the asset was the total of those two payments, which is 950,000. So that 1.1 million is a general loan. We took 950,000 to construct the asset. Therefore, we cannot capitalize 1.1 million to the asset because we only use 950,000 of the general borrowings. Okay, so let's have a look at the next slide. They are asking us for the journal entries, which we have just gone through. And then we need to now have a look at the disclosure. So this is an example of the disclosure for all of the examples we have done. Remember when we looked at example 1 and 2, we had actual investment income of 10,000 Rand. And then we had our finance costs here of these amounts. Then if we carry on to the next slide, it carries on with the disclosure. So this just shows an example of the finance cost expense here. So we had our interest incurred, less interest capitalized. So this was our actual interest incurred during the year. So that's the total of our interest incurred. But then this here is the portion of that interest expense that qualifies to be capitalized to our qualifying assets. And the main difference between these two is that often the capitalization period doesn't coincide with when we take the loan out, okay? So the net of these two, once we take out the interest capitalized, this can be taken to the qualifying assets, okay, and capitalized. Okay, I think let's leave it at that, guys. If you have any final questions, you can ask. If you're happy with everything I've gone through, you're welcome to leave. But yeah, I'll see you in the practical later today. We'll be looking at that question on intangible assets. If someone wants to ask a question, they can unmute their mics. Otherwise, you're welcome to sign off. I'm not sure when you are getting your marks. We are still busy with the process. The practical is at 3:30. I will send out an announcement on Blackboard. Where is it? It is on Blackboard Collaborate. Unfortunately, we cannot see each other in person at this stage. Okay, I'm just going to stop the recording. The practical will be recorded and I'll put it up